Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We'll be discussing the RBI's recent revision of prudential norms on capital adequacy for banks, a significant move in the banking sector. We'll also cover the latest in the metals market, where gold has fallen below 1,53,000 rupees and silver is slipping ahead of the upcoming US Federal Reserve decision. And don't miss our update on the foreign exchange market, where the rupee has opened 10 paise higher at 94.46 against the US dollar. Stay tuned as we break down what these developments mean for you and the economy at large.
Let's start with the RBI. The RBI's amendment allows a 0% risk weight on 75% of loans guaranteed under the Emergency Credit Line Guarantee Scheme 5.0, backed by the National Credit Guarantee Trustee Company for the Government of India. This effectively lowers capital requirements for banks on these guaranteed exposures, enhancing their lending capacity and supporting credit flow to priority sectors. The remaining 25% of the exposure, which is unguaranteed, will continue to carry the usual risk weight based on the borrower's credit risk profile.
Overall, this move should improve banks' capital efficiency and incentivize more lending under the scheme, strengthening support for eligible borrowers. And this balanced approach strengthens credit flow without compromising prudential norms, helping eligible borrowers while keeping bank stability intact. Risk management, of course, remains essential despite this relief.
Moving on, gold on the multi-commodity exchange fell below 1,53,000 rupees per 10 grams, dropping to 1,52,720 rupees amid cautiousness ahead of the US Federal Reserve meeting and the US-Iran peace deal news. Internationally, gold actually gained on optimism around the peace deal, easing inflation concerns as oil prices dropped. This has reduced expectations for aggressive US rate hikes, impacting global precious metal trends positively.
Technically, MCX gold faces support at 1,52,000 and resistance near 1,53,000 rupees. A break below support could push prices toward 1,51,000 or lower, and on the upside, a break above 1,53,500 could push prices toward 1,55,000. Silver mirrors this cautious tone, with support at 2,49,000 rupees per kilogram and resistance at 2,51,000. Breaking resistance could lead to recovery toward 2,55,000. But dropping below 2,48,000 may intensify selling pressure amid ongoing volatility.
Now to the rupee. The Indian rupee opened 10 paise higher at 94.46 against the US dollar, mainly due to Brent crude oil prices dropping nearly 5% below $80 per barrel, easing India's oil import bill and reducing dollar demand. That's significant given Brent crude is at its lowest in almost 3 months. With Brent crude around $79 per barrel, lower import costs and steady capital inflows could push the rupee closer to the 94 to 93.80 range soon.
Also, foreign portfolio investor outflows have moderated sharply from $12.58 billion in March to just $2.94 billion in May, helping stabilize the rupee and domestic markets. But market eyes remain on the US Federal Reserve's upcoming policy decision. While rates may stay unchanged, any hints on future moves could sway the rupee's direction in the short term. The rupee's gains might also be capped near the 94.50 resistance level amid broader Asian currency weakness.
Here's a positive green story now. State-owned banks in India more than doubled green deposits to 3,733 crores rupees in fiscal year 25-26, driven by the Reserve Bank of India's Green Deposit Framework launched in 2023. This surge reflects growing depositor awareness and aligns banks with sustainable finance trends, channeling funds into renewable energy, clean transportation and climate projects, strengthening India's green banking ecosystem.
For example, State Bank of India mobilized 317 crores rupees in green deposits by March 26, fully allocated to electric vehicle financing, with a green car loan portfolio of 3,587 crores rupees. Similarly, Bank of Baroda raised 1,164 crores rupees in green deposits, deploying all proceeds in renewable energy and clean mobility, demonstrating focused sustainable financing efforts.
Switching gears to municipal bonds, the Brihan-Mumbai Municipal Corporation has extended the bid deadline to June 19th for its planned municipal bond issuance worth 95 billion rupees, aiming to raise this amount through multiple tranches. This extension reflects growing municipal interest in local currency bonds, supported by government incentives like a 1 billion rupee benefit on bond sales above 10 billion rupees. Market data shows municipal bodies raised 10 billion rupees in 2025, the highest since 2017, with 7.6 billion rupees already issued this year. BMC's large bond offering is expected to accelerate this trend, strengthening municipal financing in India's financial capital and beyond.
Now, an important regulatory update from SEBI. SEBI now allows alternative investment funds to retain liquidation proceeds beyond their fund life if they face litigation or regulatory demands, or need to cover winding up expenses with consent from 75% of investors by value, capped at 3 years post-fund life. This gives AIFs more operational flexibility during closure, balancing risk management with investor protection, and avoids forced liquidation amid unresolved legal or tax issues.
Additionally, SEBI introduced an inoperative fund status. Such funds can't make new investments or charge fees, but can invest retained monies in approved instruments, easing compliance burdens during extended wind down. Annual reports on retained funds and liabilities must be submitted to SEBI and investors within 30 days after each financial year, ensuring transparency throughout this extended liquidation phase.
Staying with SEBI, the Securities and Exchange Board of India fined the National Stock Exchange 6.04 crores rupees for a technical glitch in April 2024 and for delays in submitting the root cause analysis report. The affected stock was not disclosed, but the penalty sends a clear message to all exchanges about accountability and the need for rapid response to technical disruptions. This fine signals SEBI's strict enforcement on exchanges to maintain market stability. Delayed reporting undermines investor confidence, so timely resolution is critical.
Here's a debt management update. Embassy Office Parks REIT has fully redeemed 400 crores rupees of commercial papers on June 16, 2026, covering 8,000 papers under ISININE 0410144072. The entire principal and last interest payment were cleared on the maturity date with no outstanding balance, reflecting the REIT's commitment to honoring its debt obligations promptly. Such transparent and punctual redemptions enhance market confidence, potentially supporting better borrowing terms in future issuances.
In sharp contrast, MTNL's bank loans of 9,419 crores rupees have been non-performing assets since August 2024, with over 3,700 crores rupees overdue in principal and interest, showing a severe liquidity crisis. Their total debt stands at 36,966 crores rupees, largely sovereign guarantee bonds and loans from the Department of Telecommunications. Investors should watch for government intervention or debt restructuring plans, as these will be critical for MTNL's survival and market stability.
Moving to credit ratings. CRISIL reaffirmed Mangal Credit and FinCorp's rating at BBB with a stable outlook on loans totaling 400 crores rupees and new non-convertible debentures of 120 crores rupees. Their assets under management grew 46% to 423 crores rupees, signaling market confidence. However, risks remain. 89% of their loan portfolio is concentrated in Maharashtra. The gearing ratio increased to 1.9 times, return on average assets declined to 3.5%, and liquidity coverage at 0.4 times indicates promoter support is still critical.
Now a concerning corporate update. Maya Apparel's revenue collapsed by over 99% to 0.087 crores rupees in fiscal year 2026. Yet they cut net losses by 26% to 0.788 crores rupees. Despite this, auditors warn about their going concern status. With accumulated losses nearing 62.96 crores rupees and a working capital deficit of 33.56 crores rupees, liquidity is under severe strain. They also face a contingent liability of 29.6 crores rupees from a customs duty dispute pending in the Supreme Court, and over 84% of their minimal revenue comes from just one customer.
Maya Apparel seeks shareholder approval to borrow 2.75 crores rupees to manage immediate liquidity needs. The Supreme Court's ruling on that duty demand and their ability to diversify revenue will be critical tests of their viability going forward. Market watchers should keep a close eye on this one.
On a more disciplined note, Hugo Finance redeemed 100 unlisted unsecured redeemable non-convertible debentures worth 1 crore rupees on June 16, 2026, following the lock-in expiry on January 30, 2025. This partial redemption, half of the original 200 NCDs issued in February 2020, tenure reflects adherence to SEBI disclosure norms and timely settlement via RTGS. The move signals disciplined debt management despite a negative one-year return of 18.89%, though their 5-year return stands at a positive 117.50%.
Now to a major banking story. HDFC Bank plans to raise a minimum of $500 million through a 5-year dollar bond priced near the US Treasury yield plus 1.20% using the Reserve Bank of India's new subsidized hedging window. This hedging scheme lowers costs by fixing swap rates at 1.5% per annum, helping banks reduce currency risk amid rupee volatility. Market expectations suggest strong demand could push pricing below 1% over the Treasury yield, potentially increasing the issuance size beyond $500 million, and this facility could attract up to $20 billion in inflows over 6 months.
The funds will support HDFC Bank's foreign branches and overseas expansion. Similar plans by state-owned banks indicate a wider market shift. Reduced hedging costs and mitigation of rupee risks could boost investor confidence and foreign currency borrowing across India's banking sector.
Let's now look at the corporate bond market, which has seen significant activity. Aditya Birla Capital accepted bids totaling 11.30 billion rupees for 2 bond issues, 5-year bonds at 8.26% coupon worth 5 billion rupees, and a reissue maturing in 3 years and 3 months at an 8.07% yield for 6.3 billion rupees, both AAA rated by CRISIL. Jio Credit also accepted bids totaling 15 billion rupees for a 5-year bond at 8.15% coupon, rated AAA by CRISIL and CARE.
SIDBI accepted bids totaling 60 billion rupees for a 5-year bond at a 7.40% coupon, also rated AAA by CARE and CRISIL. Hadker accepted bids worth 21.40 crores rupees for bonds maturing in 3 years and 1 month at a 7.23% coupon, rated AAA by ICRA and CARE. And India's Rural Electrification Corporation raised 40 crores rupees through a 10-year bond at a 7.46% coupon, also AAA rated. The total raised across recent AAA rated bonds on June 15th and 16th exceeds 86 billion rupees, reflecting robust appetite for secured corporate debt.
The range of coupon rates from 7.23 to 8.26% across 3 to 10-year tenures signals a healthy yield spread, balancing credit safety with investor return expectations. These transactions confirm sustained trust in top-rated issuers, supporting stable yields and healthy demand in the Indian corporate bond market, despite broader economic uncertainties.
Here's our infrastructure update. IRB Infrastructure Trust's board approved raising debt up to 12,500 crores rupees, mainly to refinance loans for 6 project special purpose vehicles pending regulatory approvals. They have also scheduled the 7th annual meeting of unit holders on July 23rd, 2026 via video conference to present the annual report for financial year 2025 to 2026.
Indian government bonds held steady with the 6.94% 2036 bond yield closing at 6.8651%, down slightly from 6.8704% as markets await detailed terms of the tentative US-Iran peace deal. The Reserve Bank of India raised its inflation forecast to 5.1% from 4.6% for the fiscal year, but kept interest rates unchanged, balancing supply-driven price pressures against economic stability.
Domestic liquidity remains tight due to advanced tax outflows, pushing the average bank liquidity surplus below 1% of deposits for the third consecutive fortnight, affecting money market rates. This liquidity squeeze, combined with oil price volatility, has softened India's overnight index swap rates. That's all for today's edition of the DebtCircle podcast. Stay informed, stay ahead, and we'll see you next time.